And welcome back to the Financially Simple Experience. You know, over the last almost 20 years of my career, I have heard one question many, hundreds, if not thousands of times. And recently we had a listener reach out and say, hey, what is the answer to this question? So I wanted to deal with this question in its entirety. I've never dealt with this before on the podcast, but I think it's time. The question is, what is the average cost of hiring an investment advisor or financial advisor or wealth manager, whatever term you want to put there, to manage $1 million or more? See, even recently on our website, Heritage Investors, we've had a lot of pings come in from this particular question being placed into the algorithms. So I know there is a lot of people who want to know a simple answer to this question. First of all, why? Well, you know, we have one of the greatest transference of wealth happening right now. In the last 2 months, we've had probably 3 different friends. I've had 3 different friends who've inherited money from a passing loved one. And with the baby boomer generation aging, we can't help but see monies transfer hands. And people who've never hired planners before or advisors before have now received windfall profits, and they're trying to figure out, man, how much does this actually cost, and is it worth it? So I've heard questions like, how much does a financial advisor cost? Where can I compare the fees of one financial advisor to another? What are the fees of an independent financial advisor versus a robo-advisor? I mean, I've heard all sorts of questions. So I want to do my best to answer this question today, and more specifically answer the listener's question, and that is, what is the average cost of hiring an investment advisor to manage $1 million or more? The reason why that's an interesting question is because there's a dollar figure in there, $1 million. And if you simply place that question into Google, you're going to get not that many variances on the answer. Most of the time, the answer is going to come in about 1%. So on $1 million, you're going to pay somebody 1% of that, or $10,000, in order to manage that money. But that's not really the true answer. The reason for that is many times investment advisors charge you a percentage of assets under management. It's a win-win situation oftentimes that the advisor and the client try to negotiate, where they're on both sides, they're both on one side of the table, versus having a salesperson trying to sell you a product. The advisory world has come in and said, look, we'll charge you a percentage figure to manage your money. And if the money goes up in value, then we get paid a percentage of that increase. And if the money goes down in value, we lose revenue. So obviously you want your advisor to make more money, because if they're making more money, then you're making more money. And that's kind of how the market has moved. But the reason why this question is interesting is because it doesn't ask, how much does it cost to hire an investment advisor to manage $50,000? Or how much does it cost to manage $250,000 or $333 or $761 or $4 million? You see, because at each of those price points, the price is different. In the industry that I operate in, and that our firm Heritage Investors operates in, the lower amount of money actually often has larger fees. So, for example, let's say that you have a $50,000 account, and the advisor is charging 1.2% on that. That means the advisor is getting paid $600 on an annual basis. All things staying constant, no growth. I mean, just pretty simple math here. Now, on the other hand, if let's say you have $5 million and the advisor is charging you 0.84%, then that means you're paying the advisor $42,000 per year. So that is roughly the assets under management fee structure that many financial advisors engage in. Michael Kitces, which is one of my colleagues in the financial world, who's also a researcher, has a company called Kitces.com. It's a publication company. They do lots and lots of research. He did a survey amongst financial advisors and found that advisory fees ranged from 0.5, so 0.5%, on assets over $5 million to roughly about 1.25 on assets down to about $50,000. Actually down to below $250,000. I'm sorry, I misspoke. So 1.25 for assets under $250,000. So obviously, the lower amount of assets, the higher the fee. And then as the assets grow, the fee ends up stepping down. So even his research shows that a $1 million portfolio has roughly about a 1% charge on that particular portfolio. But here's where it gets interesting. And I've had this conversation multiple times. I know from the location that our office is here in East Tennessee, I know I have a dear friend who works at a national chain that I can't throw a baseball, but I could run there without being too bad out of shape or out of breath from where I'm at. And where our firm may charge, let's say 1.2, their firm charges 1.75. And then I have another buddy of mine who is about 4 miles the opposite direction, where we may charge 1.2, they may charge 1%. And what we're looking at when we're comparing this charge is what's called the advisor fee. What the person you're sitting down with face-to-face or through Zoom these days, what they are getting paid to give you advice in relation to that portfolio. And so I even know within my own marketplace, within a very short drive, that there are individuals who are just a slight bit lower than we are in cost, and there are some that are considerably higher in cost. But here's where it gets interesting. The fees that I've been describing thus far do not cover the mutual fund or the index or any types of trading fees that might be in the account. So it's not uncommon, according to Bloomberg News, to have additional fees if you have mutual funds of 0.65 in value. So you could have additional fees from mutual funds, which add almost another 0.65 or 0.89 based on Bloomberg's research. Or if you have index funds, they could be another 0.11. Or if you have some exchange traded funds, there may be very little fees involved in like 0.001. It just depends on the actual holdings of the account. On top of that, the Securities and Exchange Commission came out and said, look, you may also have redemption fees, depending on what type of holdings you have. You may have exchange fees when you're changing one fee to another or one investment to another. There could also be account fees involved. So what I often tell folks to look at is not necessarily the advisory fee. Look at the total fee. Look at the total fee on the portfolio. So you can imagine now an individual whose advisory fee is 1.75, and then if they were to build a mutual fund portfolio at 0.89, well, now they're in the 2.5 plus range on total fee cost. On the other hand, if you have somebody at a 1% that has very little cost in relation to the investments, they may be at a 1.1% all-in fee. So when you look at the cost involved to answer this question on how much does it cost to manage roughly for a financial advisor, an investment advisor to manage $1 million, the simple answer is, well, the advisor themselves is probably going to charge you around about 1%. That's a rough number. Maybe a slight bit higher, like 1.02, or a slight bit lower, like 0.98. It just depends on where their modeling is structured at. But for the most part, roughly about 1%. And as that money grows in value, often that percentage decreases with cost. But then when you look at the underlying holdings, even though they charge 1%, they may buy assets inside there that end up causing the cost of that portfolio, the true total all-in cost, to be 2%. Whereas somebody else who had charged 1.2 may use a whole different structure and be considerably lower in total cost on a portfolio than somebody who has lower advisory fees. Now, if you're not completely confused yet, let's take it to another step. The question was actually dealing with what happens, how much is it going to cost for me to hire an investment advisor. So as we said, about 1% on $1 million. The all-in average is about 1.5 to 1.75 on $1 million. That's the rough numbers from all the research. But is there a less expensive way? Is there a cheaper way? Well, absolutely. There's this term that appeared probably 5, 6, 7 years ago in my mind's eye. Been doing this a while. I can remember when we used to have to use different type of techniques to manage money than we do today. But not too long ago, this term robot advisory came out. And basically, it's an algorithm that manages money. And you may recognize some of these terms. There's a lot of them out there. Betterment is probably one of the most well-known. They advertise a lot. Betterment. It's a robo-advisor. And these advisory firms, these robots, can charge 0.25 up to 0.5, depending on the account value, to have a robot manage your money. So you're looking at this saying, holy cow, I can hire an in-person financial advisor at 1%, or I can hire a robot at 0.25 or 0.5. Yep. See, the financial advisory world has already faced what so much of the other markets are dealing with right now. And we've already seen where robots have come on the scene with storm. And now we have research to show where they're really good at and where they're not really good at. And we have research to show how humans interact with these robots when it comes to personal finances. So you could, instead of hiring a person to sit down with, you could hire a robot and use an online service, and you may get half the cost or a quarter of the cost of using a person. But the question that I have is, even though they're less expensive, are they best? Now, of course, it's case specific. What's interesting, though, is the same company that people often follow because it's cheap, it's low cost, they are friendly, they're not the Wall Street type people who are trying to rip us off. They actually did a white paper, a very detailed white paper called Quantifying Vanguard's Advisor Alpha. Quantifying Vanguard's Advisor Alpha. Now, we'll put a link to this particular white paper in the blog and in the show notes of this particular episode because I think it's interesting. I think it's interesting, first of all, the company that actually produced this white paper, because of the history and all the impact they've had within the financial markets. I think that's interesting, but I think it's also interesting on what the results of the study yields. And this is a study of, I think it was like 6 different professionals that had designations out the wazoo and all sorts of collegiate experience and accolades. I mean, these are the experts of the industry. And here's what the study yielded. That hiring an advisor, a human, brings a lot more to the table than we often realize. So the way they measure things is what's called basis points. So go back into basis points. We don't often think this way. This is the way the financial world's positioned. They may say, hey, we're going to charge you 1 basis point. Well, 1 basis point is 1% roughly. So on $1 million, 1 basis point is $10,000, 1%, which is roughly the same fee that an advisor charges. Now, in the industry, the way it's kind of developed over time, instead of charging a percentage, they say a basis point. So here's how it relates. If you hire a financial advisor, according to this study, done by Vanguard, mind you, they say that the cost-effective implementation yields 34 basis points. So add 0.34 percentage. By having a human do tactical rebalancing. Now, we're not even talking about target band rebalancing, which I have killed at nauseum on the podcast in the past, which brings even more than what I'm disclosing here. But for rebalancing, the Vanguard study says that adds an additional 0.26% or 26 basis points. Here's the big one. Behavioral coaching adds 150 basis points or 1.5%. Asset allocation, depending on where you're going to fall in, is between 0 to 75 basis points. The spending strategy, in other words, where to pull money from, is an additional 0 to 110 basis points. And total return investing versus income investing. Now, it's hard to quantify that because every person's different in order to quantify that. But that could yield between 0 to greater basis points, as well as proper allocation. Proper asset allocation could yield between 0 to much more basis points. But all in all, what they have found is that by just utilizing the cost-effective implementation, rebalancing, behavioral coaching, asset allocation, and spending strategy, by hiring an advisor, human advisor versus a robot, it yields about 3% in net returns. About 3%. So the very company, which is the low-cost leader, and offers, mind you, robot investing, says, hey, our research says that by using a human, you could potentially, and they're not promising this in this research. Again, we're going to give you a link, let you read it for yourself, but they're saying we could yield 3% greater return. So, as a business owner, I'm often running cost-benefit analysis, and let's say hypothetically that I'm being charged 1% by the advisor on a $1 million portfolio to answer this particular question. Or depending on where the portfolio size falls, depending on what that fee ends up ultimately being, but on $1 million, let's say 1%. So I'm paying somebody $10,000 to manage my investment. And potentially tax deductible. That's a potential depending on where we're at in the code. But I'm paying somebody $10,000, but yet they could potentially give me a range of added value, according to the Vanguard study, of 3% or $30,000, which means that I'm 2% or $20,000 potentially to the good. See, I've lived this game long enough, friends. I've watched us business owners. See, we business owners, we love to research. We love to conquer the mountains. We love to be super diligent in what we want to know. Some business owners don't care to know anything about this world of investing, and others of us like to just dive deep and get into the weeds. But here's one thing I've noticed. We business owners are often risky. And because in our business we have to move and shake, we think that the world of investing is a moving and shaking as well. It's not uncommon for business owners to want to chase the nearest and greatest thing, when in fact, we end up becoming our own worst enemies. I love the fact that Vanguard's research says that behavioral coaching yields an addition, could yield, it doesn't say always, but it says it could yield an additional 1.5% or 150 basis points in the net returns. And if I'm not personally going to manage my own money because of behavioral coaching, because of asset allocation, because of emotionalism, because of all the things that I know, and I've seen these bad traits from people who are broke, and I've seen good traits from people who are multi-millionaires, I want to follow the activities that successful people have utilized in order to reach success. So my challenge to you is this. If you're a business owner, friend, do not try to do this one alone. The rules change weekly, it seems like, in this world of investing. You do need a qualified investment advisor, but you need an investment advisor who understands your risk as a business owner. See, this is where I often see. Remember, we spoke about this a few episodes ago. As a business owner, our greatest risk is our business many times. And our business has what's called a high company-specific risk. And so oftentimes we don't need to be stupid aggressive in our long-term marketable securities or portfolio that we would have in our business. In fact, we can take a little bit of alpha, a little bit of beta, a little bit of risk, a little bit of return off the table with relation to our portfolios because we should have such a good return and a good risk and a higher risk within our business. So my challenge to you is work with an investment advisor who understands business owners. Yeah, sure. We could go out and hire the robots. We can, and many people do. But when you start looking at the research, there's something to this behavioral coaching, friends. So, yeah, to answer the question directly, how much does an advisor cost? Yeah, an advisor is going to charge you roughly about 1% on $1 million. You have less than that, it's going to be more. If you have more than that, it may be less. That's a rough number for you. Again, it depends on expertise and a number of different things. But the advisor fee is not the total fee, as we looked at with relation to what Bloomberg was saying, that even the Securities and Exchange Commission. So you can have anywhere between, almost 2% on the high side if you have a small account to maybe 1% on the low side if you have a large account with relation to total all-in fees. Now that's we're sitting down with a human. On the other hand, you could use a robot, and you may pay 0.25 to 0.5 depending on the number of fees. But ultimately, what is best for us as business owners? What is best for us? For me, the answer is I love the study from Vanguard, and I've seen it firsthand in my own life that having somebody who help me control my behavior yields a better result for me. And Vanguard's study suggests that as well. Now, you have to talk to your financial advisor. You have to talk with your team. You say, Justin, I don't have anybody like this. I've never invested before. I'm finding the longer I do this podcast and the more people who listen to it, especially business owners and call us, it's not uncommon for business owners who are in their 30s, 40s, 50s, and 60s even to never have invested before. Friends, we need to know this before we go into that liquidating event of our selling our business. We've got to create this relationship. If you don't know who to call, hey, reach out to us. This is what our team here can help you with. This is what we can do. Again, this is not a recommendation. in terms of going out and trying to figure out exactly what to do. This is just a suggestion. Hey, contact a competent financial advisor. So friends, I realize life is hard. I do. I realize life is hard. I say it at the end of every episode, life is hard. I get it. Dealing with investments, it's the opposite of what we often think. It's the opposite of what we often think. We should do the opposite of what we would typically do in business. Life is hard. It is. But life is good. We're going to continue to make ourselves at least financially simple. Hey, friends, if you enjoyed this episode, do me a favor. Share it with a friend, a coworker, a peer. Leave us a review. That'll help more business owners get this content that we try to push out every week. That'll help us out. That'll also help our colleagues in the business world. So if you found this episode helpful, share it. Till next time, make it a great day.